Investors have had a wonderful run since the beginning of 2023. Stock market has been on a great bull run, up some 30% for the S&P 500. Now, a lot of stocks maybe you're feeling pricey right now, a little bit expensive, but I will tell you, as my friend Tyler Crows told me before on this program, there's always a corner of the market somewhere, something you can buy at a good valuation. And for dividend seekers, dividend growth seekers, and income investors, let me tell you, right now, there are two of my favorite high yield dividend stocks that are worth buying right now. And this is the cheapest they've been by one really important measure in 4 years. I'm Jason Hall. This is Investing Unscripted. We're going to talk about those two stocks here, what's compelling about their businesses, why they look so cheap, and why investors should be thinking about buying them. But first, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, we're going to talk about two right now. The Motley Fool is going to give you its 10 best stocks to buy right now. Go to our special link. It's fool.com/unscripted. Again, go to that link. The Motley Fool is going to give you its 10 best stocks to buy right now. You definitely want to check that out. Let's get right to it. I'm going to start with my first one here. This is Realty Income. This is one I've done a lot of videos about recently, and for good reason, because it is a great business. I think it's fair to say that they're the best operator in the net lease space. They have a wonderful track record of growth. It's well managed. They're great buyers. And as much as they've grown over the past roughly 30 years, there's still plenty of opportunity for the business to continue to grow. I'm going to hit on a couple of important metrics, give you some idea of the strength of the business and why I think going forward it's worth continuing to own, and why right now it's a really good buy. We'll wrap up at the end with that. Real estate investment trust, REITs, get some tax advantages through their corporate structure. They're required to pay at least 90% of their GAAP net income out in dividends, and the vast majority of their assets have to be tied to real estate. So Realty Income definitely qualifies for that. As a result, it pays a wonderful dividend and a high yield. 29 years of growing that dividend every year. They actually grow it every quarter. It's incredible what they've been able to do. But I want to highlight why they're really good buyers. They spent a ton of money last year, $9.5 billion in investments. Now, that doesn't even include Spirit Realty, which it acquired and closed in January of 2024. $9.5 billion deployed last year, average cash yield of 7.1%. That's really good. It creates incremental value on top of the existing holdings on a per share basis. Part of the way they do that is they don't just finance everything. They don't just issue stock to do everything. They do when it's smart. They do when it makes sense to do it. But they're also pretty good at retaining some free cash flow to use that to invest back into those assets. And they're saying they're going to spend a lot of cash, 35% of the acquisitions for 2024. Their volume guidance is going to come from free cash flow that they're retaining. That is fantastic. We know they're good buyers. 7.1% average yield, cash yield last year. That creates substantial value for shareholders. Such a wonderfully strong business. The last slide that I want to share here about Realty Income before we move on to our next stock is the market opportunity. And let's be honest, they're not going to be able to take all that market share. They're only going to be able to take a small fraction of it. But because it is so gigantic, they only need to take a small fraction of it to continue to grow the business and deliver wonderful returns. So you see on the left, the blue circle, the smaller blue circle, that's the US. It's about a $5.4 trillion market for net lease properties. You add the EU into that, you're talking about another 8.5 trillion. It is two massive markets. Most of their businesses in the US. They've begun expanding in Europe. There's still a tremendous amount of opportunity there. The share of net lease that's owned by net lease REITs is tiny, only 210 billion in enterprise value. Talking about public net lease REITs having less than 1% in Europe, and I think roughly 4 to 5% in the US. So again, tremendous opportunity to continue to consolidate. One of the things they've been good at is when the opportunity presents itself, when they have privately held net lease properties, opportunities come up, family-owned businesses, smaller operators that they've been able to acquire over time, developing relationships with their biggest corporate tenants that have some of their properties that are owned by small private landlords that they're able to acquire from those landlords over time. Just a great opportunity to continue to grow that business over the long term. Now, I promised to talk about valuation and why I think Realty Income is a buy right now, but I want to talk about both of the stocks together when we talk about valuation, why they're so attractive at those 4-year lows. Let's talk about the second stock that I want to highlight first. So the second stock is Brookfield Infrastructure, and it's for those that have followed me know that I'm a big fan of the Brookfield family of entities. Brookfield Corporation, the parent corporation, majority shareholder of Brookfield Renewable, Brookfield Infrastructure, Brookfield Business Partners, which is their private equity business, and of course Brookfield Asset Management. These companies are all kind of part of an ecosystem. Brookfield Corporation and Brookfield Asset Management are the top of the funnel for these massive opportunities for Brookfield Infrastructure. Well, it's right there in the name, it's infrastructure. So you think about things like power lines, transmission lines, distribution of things like gas and electricity, water, wastewater, transportation, rail lines, toll roads, terminals that do all kinds of things like port terminals, that sort of thing. Then you move away from utilities into the energy business. So things like storing, processing, and transporting natural gas is a big growing part of their business. And then data, like cell towers, increasingly 5G is an opportunity there. Data storage, they've really made some substantial moves into the data center space, seizing the opportunity both for growth and the Brookfield legacy of being value buyers. They're really good at paying really deeply discounted prices to acquire great assets that they can grow. Of course, they were nice enough to highlight some of the most important deals in their most recent corporate presentation. One that's really stands out to me is the 40 data centers that they acquired from Cyxtera. Out of Cyxtera's bankruptcy, found a wonderful opportunity during some weakness in the data center industry to leverage the access to capital they have to make these acquisitions. Wireless acquisition in telecom in India, really growing that business very well. So again, the key is that they're finding these markets, these growing infrastructure needs around the world, and they're moving quickly when there's opportunities, whether it's discounted assets because of distress, like with Cyxtera's bankruptcy, or just the secular trends of global population growth in the middle class that's driving the need for so much of this infrastructure. Besides the opportunity to acquire those assets and the trends of growth in those particular areas, let's highlight how it pays off for investors. So FFO, funds from operation, if you followed REITs, this is kind of the proxy for earnings per share that's really good for REITs. And to a certain extent, it's the same way for Brookfield Infrastructure because so many of the assets that they're acquiring, they last for decades to centuries. And the capital costs to maintain and improve them is substantially less than it is to acquire them initially. So it's not like a factory where you have a piece of a machinery that every 10 years you have to replace and you have to pay whatever the going rate is. These assets last for decades and generate value. So funds from operation is really useful. Their growth target is growing funds from operations per share 10% a year. And they also like to grow the distribution. That's the dividend. They like to grow it between 5 and 9% every year as well, that they've been able to deliver on for a long time. Let's talk about exactly how well they have been able to deliver on it. From 2009 to 2023, which is when Brookfield Infrastructure went public, 15% funds from operation annual average growth. And they've grown the distribution. Again, that's the dividend. They've grown an average of 10% a year. It is a wonderful long-term track record of growth for this business. Now, I'm not going to lie. Over the past few years, the stock market hasn't been particularly kind to the stocks for either Realty Income or Brookfield Infrastructure. I'm going to share a chart on the screen, talk about what's going on with the stock price of these and where the opportunity lies. So you see the purple, this is Realty Income that we let off in the video, and then below it in yellow is Brookfield Infrastructure. And this is just the stock price, the unit price for Brookfield. You can see that in the case of both went through a period kind of early and across the pandemic period. So of course they both crashed in March 2020 during the early days of the pandemic, but the stocks for both, we do this on a percentage basis so you can see, for both rocketed higher. Brookfield Infrastructure's from the beginning of 2019 through mid 2022 was up more than double, right? Realty Incomes did not gain as much. The stock is still down from its highs right before the pandemic. Now, why is that? So a couple of reasons. Number one, interest rates having skyrocketed more recently is putting a lot of pressure on all of these businesses that rely on debt to fund a lot of their growth and for a lot of the assets that they own, as they're having to refinance that debt at higher rates than they paid when they acquired the assets 5-10 years ago. So that is a pressure the market sees is affecting their ability to maintain and grow their dividends and also just, well, maintain the assets that they have now, much less even factoring in potential for growth. So interest rates is definitely a big pressure point from the view of the market on these businesses and, well, for good reason. Now, thinking about Realty Income, there's also concerns about REITs generally. A lot of the properties that it owns and its largest tenants, well, they're in retail businesses, things like pharmacies, wholesale stores, supermarkets, these large chains. And well, look at the growth of e commerce, and they're certainly concerned that is going to weigh heavily on their business. Now, I fully believe the Realty Income has addressed those concerns, talked about the strength of its businesses and how, for so many of its tenants, their physical locations are really important to their e commerce goals. And they're relatively e commerce resistant, pretty resilient to weakness in the economy that makes them really strong. So I'm not really concerned about that in the case of Realty Income. We talked about with Brookfield Infrastructure the wonderful pipeline of growth potential that it has, the growth of the global middle class, the need for more infrastructure around the world, the need to modernize the infrastructure in the US and parts of Europe. There is a wonderful opportunity to continue to grow its business and cash flows over time there. Last chart I want to share, this is the one that really hits on valuation. So I think using dividend yield as a proxy for valuation from a starting point, these are very strong businesses. Their dividends are safe, they're well protected by plenty of excess cash flows, strong, resilient customers that are paying for the leases for Realty Income, and the basically utility like operations for Brookfield Infrastructure. Its revenues are basically guaranteed. When it comes to the utility like services that it provides, its customers are going to continue paying whatever the economic environment. You look back to basically any time going back to the beginning of 2019, with the exception of the early days of the coronavirus pandemic, when the stock market crashed and you got once in a decade opportunities to buy so many other stocks, these two stocks right now are trading at about the cheapest that we've seen them anytime in the past 4+ years. So I know I've made other videos talking about both of these stocks recently, but I really wanted to highlight the valuation and why right now is such a great opportunity to be buying these stocks. Am I saying this is the bottom? Am I saying they're only going to go up and to the right from here? Absolutely not. I don't have that crystal ball. I don't think any of us do. If I did, I'd be recording this video from my private island somewhere in the Caribbean. The reality is, whether the price goes down in the near term or goes up in the near term, I can tell you at these prices, I feel confident that anybody that buys shares, holds for the next 5+ years, is going to be very happy with the results, the wealth they add, and the strong, steady stream of income that they get at these really attractive yields.